I've always been passionate about helping first-time buyers. A lot of my career was built helping first-time buyers, and I've helped hundreds of first-time buyers get started. So the buying timeline really has several steps, and really it begins with the decision. And like anything else in life, unless you decide, you can't really move forward. Indecision is probably the killer of most dreams. So we're going to talk a little bit about the decision. And then the next step is really you're going to have to choose an agent, a professional that is going to be assisting you in this process. We're going to get into the research and planning that goes into homeownership. We're going to talk about the house hunting process, which is the fun part of it all, to be very, very honest with you. And it's the part that most home buyers look forward to the most. We're going to talk about, the process of making an offer and what that looks like, what it's like and to fulfill the terms of an offer. And then finally, your final closing arrangements and getting the keys to your home. Now, let's start with the side. Is home ownership for me and why? This is the most important question anyone can ask themselves is, do I truly want to be a homeowner? And there's no right or wrong answer to that. You can, I've met many people where I've actually talked them out of home ownership. It wasn't for them. And I'll give you an example. I had a young gentleman come to me. He was 24 years old. He had landed his dream job, and he's still doing it. And it's been 10 years now, of being a tour guide, out in the Mediterranean area. Okay. And makes a huge income, but he is traveling all the time. He goes days on end with not even access to internet. And his parents are pressuring him about buying a home. And, his path where he's going in life, like it just didn't make sense. He's going to be traveling the world, all the time. Like he's never going to sit put. And I actually said, you know, don't feel pressured. Home ownership maybe isn't for you. Um, but there's very few groups that I believe that home ownership isn't for them. It may not be for them right now, but I'm a strong believer that for most people, home ownership, should be in your plans at some point in your future. But you got to decide, why is home ownership important to me? You know, why do I really want to own real estate? And just give it some thought. Why is that important? Is it because, hey, you know what, I'm new to this country and I didn't come here to just be average, or it could be, hey, my parents came to this country and they gave up so much to give me the better future. Like it's on me to just rise up and provide, have something better of my life, or it could just simply be that, you know, you want to be the Don, you want to be the king, and you want to go out and buy lots of real estate. And there's no right or wrong reasons to buy real estate. Whatever's going to motivate you and inspire you to do it, run with it. And then you really got to understand, really always think of things as 5 years out. You know, what would my life look like if I could wave a magic wand and all the resources were made available to me? What would my life look like in 5 years? You know, I think that is the most powerful question, not just when you're deciding to buy a home, but I think it's a very powerful question to ask yourself with anything in your life. It's a question that I actually ask myself almost yearly. If I could wave a magic wand and all the resources were made available to me, what would my life look like in 5 years? Answering that question surprisingly will tell you a lot, things that you probably never thought of, because the resources, the money, the details, you'll figure that out along the way. But you got to understand, why is it important? And, you know, when you look at it 5 years down the road, you start realizing that, hey, I should have been planning already. Okay. When is it the best time to buy a home? I get this all the time from, younger people when they're thinking about buying their first home. And the reality is, unfortunately, the best time to buy a home was 5 years ago, you know. And I always tell people, you don't wait to buy real estate. You buy real estate and wait. As the charts on your screen will show you, in the Hamilton area, the average price for a home in 2009 was $302,000. In 2015, just 6 years later, the average price was 470, which is a significant price jump. But by 2020, it's costing us almost $695,000 to buy a home in this area. And I can tell you, 2021 just started. That number has already passed seven, and it may look like 750 by the time the year is done, with what's going on in the marketplace. And same thing for the GTA. I mean, the GTA numbers are actually, you know, higher, which is of no surprise, of course. 2009, the average price to buy a home was 395,000. 2015, it jumped up to 622, and currently it's almost $1 million for the average price of a home. To put things into perspective, when I started real estate 16 plus years ago, I actually started in the GTA, in West Toronto for the most part. And back then, most of the homes I was selling in Toronto, get this, was about 200 to $210,000. I even sold some homes for $188,000. So it goes to show you how fast things change. And I always tell people, especially young people that are thinking of buying their first home, you know, it's never too soon to start. The sooner you start, at least the path of brainstorming, mapping it out, start working on the saving for that down payment, because it is almost impossible to wait until you have the perfect down payment size. My thought process is, grab whatever amount you got and figure out how much more do you really need. Because this market moves at a pace that most people can't save up to keep up with. When the average home price is going up 25,000 or $30,000 in a year, most people can't save that much money in a year. So the sooner you start planning and figuring out how you're going to do this, and towards later in the presentation, I'm going to talk about the actual dollars and cents needed to buy a home. But the main message here is the sooner you start, the cheaper it's going to be for you in the long term. The next step you want to do is you're going to have to hire a real estate agent. And, the big question is, how do I find the perfect real estate agent? And the answer is, look at your screen. Just kidding. But where you really want to start is, does someone someone that you highly trust, a family member, a friend, a coworker, someone that who you highly trust, have they had a good experience with a real estate agent that delivered results? That's the first place you start. The second step could be a referral from some type of financial network, and really start from there. And I would say, at the very end of it, the worst way to pick an agent is online, to be very honest with you. Like the restaurant industry and many other industries out there, half the reviews and half the star ratings on realtors online, they're fake, they're self-generated. It's unfortunate, but that's the reality. So when you're looking for an agent, please start with someone you know. Ask a family friend, a coworker, to point you in the right direction. If you're thinking of a certain neighborhood, maybe visit some of the open houses. Although right now with the pandemic, none of that's existing. But if you're seeing the same face of the same agent come up in a particular area that you're looking at, there's a sign that there's an expert, at least in the general area you want to buy a home in. Okay. This is the biggest decision of your life. You don't want to trust it to anyone. Like, you want to trust it to someone that's got a proven track record of not just doing a lot of sales in real estate, but having a track record with working with first time buyers. Because first time buyers, you know what you know what you don't know. And there's a whole bunch of stuff that you don't know, right? And you're really going to need somebody that can take a step back, have the patience, and talk you through everything, hold your hand, and walk you through the entire process, take on the majority of the workload, and just leave the fun stuff up to you. Okay. And once you've done all that, a good agent will sit down and do a full consultation with you, whether it be through a Zoom call like this, one-on-one. They'll go through, what are your goals? What are you looking to get? And go over that. And once you find that right agent, the best thing you can do is request to get a buyer agency agreement. And a buyer agency agreement is just a contract, stating that, yes, I've hired this particular realtor to represent my needs in helping me find a home. The reason why that's so important is that, one, it protects you, that you have a full contract with somebody that's going to represent you. At the same time, it also indicates to the agent that's like, hey, I have a serious client who's looking to buy their first home and they've totally committed to working with me. And that's also an indication to the agent that's like, hey, I got so many hours in the day. These people signed a contract with me. So therefore, they're going to get all my attention first, all my efforts first. If I see a great deal in the market, this is the first person I call. And that's one of the many, many reasons why getting a buyer agency agreement signed is so important when working with a realtor. How are we doing there with the audience? Are we still on track? Is there any questions coming through so far? Axel Eustace?
Yeah, no questions so far.
Okay, good.
But what you're explaining is pretty clear. So.
Okay, good. So your number one role for your agent is just to be your navigator. They're going to hold your hands, help you from start to finish, and really after you move in. A good realtor just doesn't disappear once you get the keys. They'll be in touch. You need a contractor. You get this weird bill in the mail or this weird letter, and you're like, oh my God, what's this about? Should I be worried? Is this a scam? A good realtor is just not going to leave you alone, after you get the keys to your new home. They're going to help you budget. And a lot of people think that that's the mortgage person's job. The mortgage person's job is to get into the details, and I'll get into that in a bit. But you don't necessarily have to put yourself into this whole application process and credit checks and all that kind of stuff to get the ball going. A realtor can simply sit down with you and just have a quick analysis based on your yearly income, based on your current, finances. Are you in a position to buy a home? And if you're not, how far are you? What do we need to do to increase some of that down payment to get you started? And then as you're making progress, the minute there's a need to get the mortgage broker involved, then we put you in touch with the right professionals in the mortgage world to assist you. Okay. We're also going to assist you to determine the best location and property type for you. Unfortunately, there's this stigma, this stereotype that a lot of first-time buyers fall into, where they think that, hey, if I'm a first-time buyer, that means I gotta be engaged or in a deep relationship, and I have to buy this townhouse with a white picket fence and get a golden retriever, or I gotta buy this fancy little condo downtown next to my other professionals or my better half's professionals, and that's what a first-time home looks like. And to be very honest with you, more than half of people buying their first place is none of that demographic. You know, the consultation, when I or any other great agent sits down with you guys, is just says, based on your lifestyle, based on your habits, based on the things you like to do for fun, based where your work is, what's the best property type that's going to, make sense for you, and what location is going to make the most sense for you, and can we find that within your affordability range? And if it's not, then what's our plan B? Your agent's going to hunt for the best deal for you, not just what's on the market, but even off the market. An experienced agent who, has an experience in a certain marketplace, has access to properties, not just on realtor.ca, because let's face it, even the public can sit on their couch and go on realtor.ca and search homes. A good realtor will even have access to homes, or at least know about them before they hit the market. I mean, 2020 alone, I had 4 different homes that I sold that, realtor.ca never saw or heard of. These were off-market deals that were done. So that's another important thing, that when you're picking a realtor, ask questions during that consultation or during that interview process. It's like, do you get off-market deals? And if so, what resources do you have for those off-market deals? Okay. And obviously, their role is also going to be to draft up all the paperwork that benefits you. That they're going to structure that offer that best represents you, not the seller, not him or herself, but what's best for you and keep you safe. And obviously, coordinate every step of the way with all the industry professionals. As a realtor, being in this industry for many, many years, I know the good lawyers and I know the bad ones, and I'll steer you away from from the bad ones and guide you to the good ones. Dealing with appraisal companies, dealing with moving companies. We're going to be your central source to connect you to all the other industries that you need to connect with when you're making that step to home ownership. Here's a question that everybody asks all the time, and this is where many people get lost, when they're trying to figure out this home ownership thing is how much can I afford? And then they get on the mistake of, Googling it. And Google's got some great answers for many questions, but when it comes to real estate and buying a home, I find Google's answers are just as valid as health questions. When you figure out it's like, oh, I got this little rash on my arm, and you start Googling it, all of a sudden you think you got cancer and all these horrible things. You start getting all this information. It's blown out of proportion. And real estate's much the same way. So I'm going to give you a quick snapshot, and there's a lot of variables here that don't matter. But the rule of thumb is, how much home you can afford or how much mortgage you'll be approved for typically is 4 to 5 times your income. And that's assuming that you have no debt. Okay, no student loans, no car payments, no credit cards. So assuming that you're totally debt free, 4 to 4.5 times your income is usually what the bank's going to approve you for, provided that your credit rating is also average. Okay, so for example, if you're making $100,000 a year, your max mortgage amount is going to be $400,000. Then you add your down payment on top of that, which will equal, how much house you can buy. So as a further example, if you have a $50,000 down payment and you're making $100,000 a year, chances are you'll be only approved to buy a home of no more than $450,000. The two logos at the bottom of your screen, we have the Canadian Mortgage app. It is my favorite app when it comes to calculating home ownership. It's on all my devices. I use it regularly, and I encourage anyone on this call to download that app today. If you're thinking of home ownership, not just today, even 10 years down the road, it's a great way to plan. The calculations are bang on, they're done right. They're very detailed. You can enter even all your debts into it as well, and it'll give you very, very accurate figures. The only thing the app doesn't do, which no app out there can do, is it doesn't factor in your credit rating, which is something we'll talk about later on in the presentation. But it is, the most accurate source I know out there in the world of mortgage calculators that is reliable. Okay. And what I like about it is that it's unbiased, which means it's not owned by any of the banks or anything like that. You can actually check what all the lenders out there, what they're offering on interest rates. It's all posted on there. So it's good free information, unbiased, and you're not getting these subliminal messages and, please enter your email address, and all of a sudden every single day you're being bombarded with requests and spam and junk mail. So that's why I love that app. The second app that's here is the Lowen Group Mortgages. They're a fairly large mortgage group. They're based out of Burlington. They do service all of Ontario. And I would say that's more of an app when you're getting closer. What I mean by closer is like, I'm hoping to be moved into my first home by this summer, this fall. This app starts to make more sense. And the reason why it makes more sense is that it gets a little bit more detailed. You can actually apply right online for a mortgage, have one of the representatives follow up with you. And they're honestly the best in the business. You can do all the research you want about the Lowen Group. They're top, they're in the top 20 in Canada. I think they're in the top 5 in the entire province for customer satisfaction. So they are phenomenal. I don't make anything from endorsing the Lowen Group. There's no financial interest on my behalf for introducing them. But I definitely believe that, I want you guys, whoever you are on this call, to have a good experience when it comes to home ownership and mortgages. And that's why I encourage and promote the people that I've worked with, and I trust them. So when you're planning your purchase, you're going to have to plan the following things, your down payment resources, where's the money coming from? And here is the long-winded question for many people. And really the first step is, do you have personal savings? Are you personally have some money set aside, or are you creating this, you know, buy my first home bucket or account? You know, are you putting anything in there? And if so, how much do you have in there? You can actually also use RSPs to buy your first home, believe it or not. So if you currently have been contributing to RSPs and you have a balance in there, you can actually withdraw up to $35,000 per individual. So if you and a significant other are thinking of buying your first place, that means that person A can withdraw 35,000 from their RSPs, penalty free, tax free. Your other significant other could also withdraw 35,000. So all of a sudden you have $70,000 down payment. And this is the one avenue that I'm seeing a lot of, more and more. I mean, it's been around for decades, but I think people have actually got wind of it and realized that, oh my God, like I don't have to stress about generating this extra down payment money when you've had it all along because of, the company you work for or whatnot. The next big resource for that I'm seeing a great deal of, I would say in the last 3 years, is the bank of mom and dad, as I so call it, or a gift from a relative. It is perfectly fine and acceptable by any lending institution that you received what they call a gift. Because if you word it as a loan from mom and dad or from Uncle Joe to buy a home, the banks don't want to hear loan because it sounds like you're getting more debt. However, if you just have a gift letter, sign that, hey, I've given Bob here $30,000 for him to buy his first home, the banks are perfectly happy to accept that as your down payment resources. No, you can't use your credit card as your down payment. It's highly discouraged, and most lending institutions aren't going to allow you to do that. The flip side, I always tell people, is that if you have a credit card with enough room for a down payment of a house, then that's a really good credit card, and you're probably in a much better financial position than you realize. Okay. Now, for those of you watching this, it's like, well, I don't have RSPs and I don't have a rich mom and dad bank or a rich Uncle Joe bank. Where do I get down payment money? How do I start? Where am I going to get this? I only make X a year. How am I going to do it? And the answer is, like everything else in life that's worth getting, it's you're gonna have to make a sacrifice. You're gonna have to do a little bit more than what you're doing. Because if what you were doing up until now worked, you would have the down payment money. So if it's not there, then it's like, hey, what do I need to do differently? And it's not going to happen overnight, and that's okay. I've seen clients start Ubering 2 nights a week, and it's like everything I'm making from Ubering is going into a separate account, interest bearing. So it's accumulating interest as it's sitting there, and that's going to be my down payment money in 18 months. I've seen other people start freelancing journal work and proofreading stuff. I've seen clients get creative. So my advice to anyone on this call is, if your down payment sources aren't in there, and if you're feeling that, hey, based on the money I'm currently making or that I projecting to make over the next 2 to 3 years, I don't see it giving me my down payment money, then it's like, okay, let's go to step B. What can you do over the next 12, 18, 24, 36 months, whenever that home buying dream is for you? What can you do? How much time can you dedicate to doing it to generate that extra income to get you there? Okay. And like I said, I've seen everything from people picking up a second part-time job to just a little side gig, a little side hustle, maybe asking for overtime at work, getting on a roster. Anytime somebody calls in sick, they're jumping the gun. When you get your tax returns at the end of tax season, don't touch it. Throw that into the account. There's a number of different things that you can be doing out there to help fund that, you know, that that bucket for your down payment.
Question, Mike.
Yes.
On the topic of gift from relatives, so you do need a letter once, let's say, uncle, mom, and dad send you 50K, for you to help you get that down payment. You do need a letter from them saying how much they're sending you, and that is a gift. The bank will ask for that.
Absolutely. And the reason why the bank wants some type of documentation, there are many lenders out there that actually just have a form that you and that relative would sign. And so it's a pre-printed form. You fill in the amount, you know, Rich Uncle Joe signs it, me, first time buyer signs it, and it's by the bank, and that's sufficient. Other banks just want to see, a proper letter signed by both parties, along with some photo ID. They will need something. And the real reason for that is they just want to make sure you're not laundering money for the mob, right? Like they want to make sure it's like, we're looking at your bank accounts for the last year. How all of a sudden do you have $50,000? Did you steal it? Are you money laundering? And that's the real reason why the banks just want to see something in writing. It's really to satisfy themselves that this is, ethical, legal money that you've come into.
Okay. And does it have to be only relatives? Like a friend cannot, if let's say we're doing some other business side and the business is paying out, and you obviously doing business with a friend of yours, and then you're taking your share out. So like, do you have to explain all of that?
Traditionally, yes. The bank, the minute what's the wording I should say? As the fading of the relationship fades, the more questions the banks ask. When it's just mom and dad funding the money, banks will ask a lot of questions just to sign letter. The minute we get into, hey, my coworker is doing this for me, they're going to be like, okay, who's your coworker? Do we have a signed letter? And can your coworker provide 4 months bank statements showing that this money was actually in their account for the last 4 months? Right. So as the relationship gets more eroded from family, the more questions your banks will ask. So be prepared for that. I've rarely ever seen a bank say no, but they will ask a little bit more questions.
Okay.
Did that answer our callers or our viewers' question?
Yeah, I have another question here that just came.
Yep.
That was my question, by the way. But yeah, another question here is, can you unpack the government of Canada first-time homebuyer incentive program announced recently? Shared equity plan, and is it a good option? Is it a good option or not for young professionals to get into the house market for down payment in GTA?
You can. That program still has a lot of questions to clear up with us in the industry. I've also seen several programs, even with municipalities, that are similar to that Canada First Time Buyer program. They're just so vague that they don't allow the opportunity. So, for example, City of Mississauga does have a First Time Buyer Incentive program. Well, they'll provide the down payment for the property. You can't make more than $75,000 a year, and the house that you're buying has to be a single family home and cannot be more than $400,000. Well, you can't find a home for under $400,000 in Mississauga, under $75,000, household income. Like, it's just so fine written. Very few people can even take advantage of it. So it's going to really depend person to person. These programs are lengthy to get answers. So if that's an avenue any of our listeners are curious about, yeah, by all means, get on the Canada website, start applying, and see what's made available to you. Do you qualify? Because these programs take forever to get answers and to get resources. And once you're getting all those answers, then you got to look at, this is great. Is it going to be valuable in my marketplace, right? Especially if you're thinking in the GTA or the GTHA, where prices aren't what they used to be. Many of these programs are just not going to work. Okay. They'll have exclusions as well, that your certain type of condos are excluded from these programs. So they can be great, but they're not for everybody. And I would say 1 out of 10 people at most even get these programs. The other thing that people aren't aware of or they get really confused about is CMHC, the Canadian Mortgage and Housing Corporation, has a mandatory fee or insurance policy if you have less than 20% down. And as you can see by this chart, you know, if you're buying a $500,000 property, a 5% down payment is $25,000. And for some people, that's a stretch, just getting there. Never mind getting a $100,000 down payment, okay? So it is law in Canada that anyone that's buying a home, especially in the province of Ontario, that has less than that 20% down, they're going to need mortgage insurance. And what is mortgage insurance? Really, what you're doing is you're buying an insurance policy for the bank in case you don't pay it. That's really what it is in plain English. So what it's saying is that, hey, the bank is worried that you're buying with such a small down payment. So they want an insurance policy provided by us. The cost for this policy is $19,000. And this pretty much protects the bank if you don't pay the mortgage. So what happens is if, you know, knock on wood, things get really bad for you and you haven't paid the mortgage for 6 months, RBC won't care because they're just going to turn to CMHC and be like, hey, these people aren't paying their bills for 6 months. You know, I need you to buy out the policy. And then CMHC takes over, you know, and goes power sale. So that's really what CMHC fees are all about, is the bank is taking out an insurance policy because they consider you high risk. But the funny thing is they're making you pay for it. You know, it's not fair, but at the same time, it's because of CMHC and this policy that has allowed so many Canadians to get into the home buying market because this program exists. You know, because if they didn't, banks would say no to a lot more people. And here's the cool thing too that some people don't realize is that although there's this $19,000 premium when you're buying with a small down payment, people that buy properties under CMHC policies are actually going to get a better interest rate than somebody walking into the bank with a $100,000 down payment. And the reason why that is the bank says, hey, this person with a big down payment, you know, that means I got to take all the risk. I don't have an insurance policy on them. So I'm not going to give them my best interest rate. I need to make some money here in case things go south. Versus the first time buyer that walks in, they have a full insurance policy. Well, hey, you know what? We're going to give them our best rates out the door. We don't even care if we make much money on here because we're so protected. We got nothing to lose. So traditionally, first time buyers actually get better interest rates than anyone else if they're putting less than 20% down. So it's a double-edged sword. And the math works down like this. If you're buying a $500,000 home, your down payment is $25,000, but CMHC premium is $19,000. That gets added to your mortgage amount. So really, your mortgage amount after CMHC fees is $494,000. So buying with 5% down almost means buying with 0 down, unfortunately, but it gets you into the door. Your monthly payment works out to be, as you can see here, is about $2,091 a month. If you're putting a little bit more money down, or say you double it, I'm going to put 10% down. Your down payment is $50,000. The CMHC fee is still a good premium of $13,900. Brings your total mortgage to $463,950, and your monthly payment is $1,964. And these two numbers is of great value, and I want all the viewers to just pay attention for a second. Because some people ask me all the time, what if I put more money down? Will it lower my mortgage payment? And the reality is, unless you're putting substantial money down, it doesn't make a difference. So I always encourage first-time buyers, if you have $35,000 down payment, it's not quite enough to get out of this insurance premium. I would say just put the minimum 25, keep that remainder $10,000 into a separate bank account, and keep that as break glass in case of fire, you know, break glass in case of an emergency, you know, work slow down, you had your hours cut. The pandemic is teaching us a lot about these things right now. So don't put more money down, because as you can see, it's not going to make a huge difference monthly by putting an extra $25,000 down. So don't put yourself in a cash poor position if you're fortunate enough to have a little bit extra down payment. The only time it starts to make sense is when you're putting big amounts down. So, do you put 25,000 or you put $100,000 down? Well, there's a significant difference from $2,091 a month to $1,693, but you're putting almost an extra $75,000 down to make that happen. Okay. So I coach my first time buyers all the time because remember I said earlier in this clip, you know what you know what you don't know, so you research it. And then there's stuff you don't know that you didn't know. Well, that's where people get into trouble with cash flow. And I always recommend the first time buyers have a cushion, and the rule of thumb is, $2,000 to $5,000 at bare minimum, and in a total separate bank account that hopefully you don't even have a debit card for, because that means you're not going to touch it that easily. And you just want that because there's going to be surprises when you own a home or a condo. And there's going to be things you didn't realize you had to spend money on without even getting started. And here's a funny story. After I bought first home, the person I was with at the time moved in. We're sitting on the couch and it's like, hey, do you want a coffee? Yeah, sure do. You know what? I'll go get us the coffee. I got up off the couch so excited, walked into the kitchen and realized, oh, I don't have a coffee machine. Time to go to Walmart. And then, that was okay. And sure enough, that weekend, door opens. I'm like, hey, honey, welcome home. And she's like, are you going to cut the grass? Because that grass is getting a little long. I'm like, yeah, you know what? I'm going to get on that today. Well, I walked into my garage. To my surprise, I realized I don't own a lawnmower. So now I had to go out and buy a lawnmower. So I share these stories with you from a personal level so that you don't get caught up in cash flow issues with home ownership. And the rule of thumb is $2,000 to $5,000 is a good cushion. And if you have more, instead of putting it down, you're not making much of a difference on your monthly payment, keep it as a safety net, and just let it sit there because you never know if something happens. Your mortgage broker. So your mortgage broker, mortgages is pretty much the loan that you'll take against the property to help you buy it. It's very similar to a car loan in the sense that, you're putting up some money and then the bank is also putting up money so that you can get this house. Okay. Your mortgage broker is the best source to get a mortgage. I get this question all the time. Do I go with a broker or do I go with the big banks? And my reply is you go with a mortgage broker every time. Every time. The biggest mistakes I see young people do all the time when they're thinking about buying a home, they make an appointment with their bank or they just walk into their branch and it's like, I'm thinking of buy a house, I need to talk to somebody. And unfortunately, that is the biggest way to get misled. And I'll tell you why. And this is the industry secrets that never gets put out there. Unfortunately, when you walk into a branch, most of the people working at a branch level are entry level positions. Teller's kind of entry level, and then your next step up is an FA, a financial advisor. Most of those people are straight out of school. Most of them just know how to read spreadsheets. They're not going to give you adequate advice. They're just going to punch in a bunch of numbers into a computer screen, which frankly, you can do at home on that app that I told you. And they're going to give you misleading information. And my biggest pet peeve with branch level employees in the mortgage industry is this. All those people working at the branch, they get paid by the hour or they're getting paid a certain salary. Come 4:59 in the afternoon, they're packing up, they're closing their laptop, they're getting ready to go home. Even though your file was on their desk and it was the next file, they're going home. There's no incentive for them to help you get the most, mortgage amount, the best mortgage product. There's no incentive. They're just going to offer you what they got. And they're on a when we get to your file kind of attitude. When you're working with a mortgage broker, it's totally different. They're going to collect your information and create a profile. Based on how your profile looks, a mortgage broker has the expertise to know you know, which bank's going to make the most sense, and they're going to shop the marketplace for you to get you the best interest rate, but more importantly, the best terms of the mortgage. And another thing that most people don't realize, and it's not just first time buyers, it's just people in general, even people in their 60s that have owned home for decades. What they don't realize is that banks are a business, like, you know, like a restaurant, like a car dealership. They're just a business. And every bank has a target market and it's constantly changing. And here's an example. In the 90s, you know, CIBC was the bank for immigrants. If you immigrated to Canada, you needed to get started, you need a loan for a car, you needed a loan to buy a house. Like CIBC was the bank because that's who they wanted, that's who they were going after. Well, right now, CIBC, if you're not in your 50s into 60s and you aren't interested in buying more RSPs or taking out loans to put your kids through university, or you're not out to buy your second cottage or your vacation home in Florida, CIBC is a tough bank to get approved for as a first-time buyer. And that's constantly changing. I mean, RBC, I would say up until the pandemic was like, you know, a very aggressive bank for millennials. Like they really wanted millennial money. And they were doing everything possible to get them approved. So when somebody was on the gray scale of getting approved, not approved, RBC would always push it. That was their target market. And I share this with you guys because as a consumer, you're not going to know, you know, what kind of a target market's after my business right now. Whereas your mortgage broker is going to collect your information, your employment, your pay stubs, your NOA tax returns. They're going to create a profile. Based on that, they're going to know which lenders are going to be the easiest to work with for you. And that's why you want that professional, because they're going to know how to package it and they're going to know who to shop for it. And they're going to negotiate terms in your favor. And the best part is a mortgage broker doesn't cost you anything. The mortgage broker gets paid by whichever lender you end up getting the mortgage with. And they'll shop the market. They'll go to RBC, they'll go to Scotia, TD, Merrick's Financial, Meridian. Like they're going to shop the mortgage for you. And believe it or not, you know, there's some great deals out there outside of the big banks. I mean, there are places out there that lend money that people didn't even realize. The Teachers Credit Union gives out mortgages, and they actually give out favorable terms. The Croatian Credit Union is a great place even for first-time buyers because they actually have decent rates and they're very, very flexible in their terms. So work with a mortgage broker. They're going to be the best person to work with to get you the best deals and keep you safe.
I have a question for you, Mike.
Yep.
What would you call a good term?
So good terms, there's so many of them, and it really comes down to your personal circumstance. You know, for example, many banks right now only offer 25-year amortization. However, for somebody that is in the gig industry, you know, that it's like, I'd rather have the lower payment because I do gigs, right? Like I'm either a Uber driver, I'm an artist, you know, their income's always up and down. So it's like, oh my God, you know, if there's a lender that offers a 30-year amortization where it's going to lower my monthly payment a little bit, and then if I'm doing good with gigs, I'm just going to put extra every month. Like that's an obviously good term to have. Other good terms are prepayment privileges. I can't tell you the number of times that clients call me and say, Mike, I'm not going with your mortgage broker because, you know, they're great and everything, but my bank just offered me like this ridiculous 1.5% interest rate. I'm like, read the terms. What are the pre-privilege payments allowances? And they're like, well, I don't know, but I signed on anyways. It turns out they got that 1.5 deal rate, and that was great, but they're not allowed to prepay the mortgage, which means if they get an inheritance, you know, if a family member dies and they get this money, if they win the lottery, they can never pay off the mortgage until the maturity date 5 years later. And here's what I see happen all the time. People pick rate. They don't look at prepayment privileges. And then 3 years into the mortgage, you know, they're expecting a baby. They need a bigger space. They need to sell the condo, buy a house. And the bank says, you're not allowed to cancel the mortgage. And if you do, it's going to be a $12,000 penalty. You know, I'm actually working with somebody right now. We're putting their house up on the market on the 19th, and they did just that. They went with Scotia, and I'm not bashing any bank here. You know, they're offering their products, right? They got a really good rate, but their penalty is huge. We're looking at a $21,000 penalty to break their mortgage. So they got to write a check to their bank for $21,000 just to say, I want to pay you off, you know, over and above. So terms are very, very important in that sense. Prepayment privileges, amortization schedule, um, mortgage penalties, you know, should you decide to move and sell the property, or you and your partner break up, you know, what are the penalties going to be like? So you really want to look at the fine print because they're super, super important.
Okay, thanks.
Now, here are really the 5 pillars of how any bank will decide to lend you money. And the first one, you know, is the most obvious: cash. How much down payment are you bringing to the table? You know, are you bringing 20,000, or are you bringing in $200,000 as your down payment? You know, this number, the banks look very closely, like, because really they're going to be your partner in buying this house. And the more of this you bring forward, the more relaxed they're going to be to lend you money. The second thing that banks look at, and this is a huge one, and this is growing exponentially, I'm finding in younger people today. It's almost scary, unfortunately, of how much debt I'm finding people have at a younger and younger age. And this is huge. The biggest debt issues that I see out there, believe it or not, aren't so much credit card. Where I see people getting into trouble are vehicle loans. You know, they really, really hurt you when it comes time to buy a house. And people ask me all the time, so does that mean because I have a car loan, I can't buy a house? No, the answer is not that at all. But the banks are going to heavily consider how much is your car payment, you know, how much of your income is it chewing? And their biggest worry is, how long is your car payment? Meaning, do you have a 60-month loan, or did you get one of those Kia or Dodge 96-month loans? Because the 96-month loans, they get really concerned because they know what's going to happen. You know, most people aren't holding on to a car for 8 years, right? They buy the car 3-4 years into it. They either don't like it anymore, they like the newer model better, or it's starting to give them problems. Well, guess what? You're only halfway into your loan, which means you owe more on the car than what it's worth, and you're just going to create more debt to get out of that car loan. So the biggest trouble I find, or where banks get really worried when it comes to debt, car loans is a big one. Obviously, credit card debt, you know, they're okay with some, but how much do you have in comparison to your income? I mean, if you're making $100,000 a year and your Visa's got $2,500 on it, the bank's not even going to look at it. Like, that's insignificant to them. However, if you're making, you know, $28,000 a year and you have $2,500 in credit card debt, the banks are going to be much more concerned with those figures. So it's going to be proportionate to your income. Obviously, your income is going to matter. They're going to want to make sure that what you make is enough to carry the property. The good thing is that banks only look at your gross income. That is the income before CPP deductions, before taxes. They just look at your gross annual income, which is a good thing, right? Especially if some of our viewers, you know, if you're fortunate enough to have a job where it's part of a union and there's union dues, you know, there's quite a bit of discounts every month, but the bank's just looking at the gross figure. So they need to see how much money are you making, and, you know, how many income sources do you have? Do you have one job? Do you have 2 jobs? You know, do you have a good paying job? You also got a little side hustle going on. I'm working with a young gentleman right now. He works for WSIB, so he's got a good government job. Plus, he's an artist, and he's, unlike most artists, he's actually, you know, opened up a business name, which is his personal name, and he's actually recorded and reported the sales of all his paintings. And that's looking really good for him right now. He got approved for a very healthy mortgage amount because of his income. Not just so much the amount, but how structured everything is. Next is your job security. And I would say up until the pandemic started, banks weren't so worried about job security. If you're at your job for a year, that was good enough for them, right? Since the pandemic started, banks are really, really looking at what type of industry are you in. And here's an example I actually had last fall, and it blew my mind. I had a gentleman, 42 years old. So, buying property a little later, and there's never a bad time. And he had been banking with his bank, CIBC, for over 10 years. So him and his wife were buying a $550,000 property. They were putting $110,000 down. So they were putting a good amount of money down. Stellar credit ratings, stellar. Their RSP balances were very healthy, and they weren't using RSPs. They were using cash money in their bank account. She is a school principal for a school in Mississauga. So she also has a great job, great credit. And the CIBC turned around and says, we're not interested in doing the mortgage. Absolutely not. And then it's like, he was shocked. He's like, fine, I'm going to go to my wife's bank at TD and we're going to go there. And they also said no. Here's the interesting thing. The reason why both banks said no is that Mike is actually a mechanic for Air Canada. So he is the mechanic that works on all the planes. And even though he had been working for Air Canada for 18 years, he's been there for a long time. He's got tenure with his pension. He's up there. He actually had a job letter from Air Canada saying, although the pandemic has reduced tourist flights, we still have daily flights and we're doing a lot of cargo shipments right now, and our mechanics are vital. No mechanic has been laid off or had hours cut. As a matter of fact, most mechanics have had their hours increased. He actually had a letter from HR outlining all of that. But because he was in the airline industry, the bank said no. So right now, your job security, the industry that you're in, is going to play an effect with some of the banks, and especially the big boys. The big boys being TD, RBC, Scotia, CIBC. Those, they have enough business that they're not afraid to say no right now. So if you're in an industry of hospitality, travel, tourism, anything in the food industry, hopefully this area here, your income is extremely high, that they'll all ignore this, or you're going to have to go to a B lender. Like I said, Meridian Financial, a teacher's credit union, they'll gladly give you your business. But understand job security right now with the pandemic is being much closer looked at than it was before. And the last pillar is credit. What is your credit rating? And for anyone on the call right now, if you don't know your credit rating, your alarm should be going off. Anyone that's on this call right now, please, please, please go to Equifax.ca, go to TransUnion.ca. Do not use Credit Karma. Credit Karma is a US-based company. They don't have the resources that the first two use. And regardless of what Credit Karma says, no institution will use Credit Karma as your credit report. So Equifax.ca, TransUnion.ca, log on today, find out what your credit score is, because you'll need to know, number one, for yourself. And more importantly is mistakes happen. I would say 1 in 5 people that come to me about buying a house, there's a mistake on their credit report that no one ever knew about. And we're finding out too late in the process. So go on there. Maybe they got still your old employer listed. Maybe they have a credit card still listed as outstanding that you've actually closed the account like 3 years ago. It's actually happened to me personally, where I had a MasterCard that was on my account with, I think it was like a $400 balance showing on my credit, and that account had been closed for over a year. So you want to get stuff corrected, because if there's a hiccup or if there's something on there that shouldn't be on there, hey, get on the phone, start with the provider. So if it's MasterCard or if it's your Sears card, actually millennials don't go to Sears, but maybe your Canadian Tire gas card. is on there with a mix up. Well, start calling them, why is this showing up on my credit report? And get that corrected before it starts to cause you damage.
Mike, a quick question here. If you were buying your first property today, what type of property would you target and how much down payment would you save?
That actually goes right into my next slide. So whoever's asking. With regards to down payment, I would say, as much as you can always helps. But right now, because of the rising real estate prices that's happening at such a fast pace, get in with the minimum down. Yes, it's nice to have $100,000 down, but if we can get your mortgage approval with $25,000 and you already have that money, do it now. Do it now before that $500,000 house is $650. Because unfortunately, by the time most people save to go from $25,000 down to $100,000 down, the house they bought went up in price by 150, 200,000. So they're actually further behind debt wise. So to answer that question, start with as little money as the banks will let you use. If the banks are okay with you using $15,000 down to buy a first place, then do it. Do it now. That would be my first thing. What type of property should you buy? And the answer is, are we frozen or are we working here? Hello, Eustace?
Yeah.
We're working? Okay.
Yeah.
He just looked really still and I wonder if my computer froze. But going back, what type of property should you buy? And the answer to that goes back to one of my first slides. And what does home ownership look like to you? Do you want to be out in the country? Is like rural living kind of your thing? Is that where you want to end up? Because if that's the answer, then that's what you should buy. Maybe you're a downtowner, you want to be in the nightlife. It's like, Mike, I gave that question some thought. Where do I see myself 5 years? Like, I still want to be in the city. I still want to be walking distance to my favorite restaurants. And, I work long hours and I like to, grab a quick beer on a patio with a work colleague on my way home. Like, city is my thing because I don't want to own a car. I'm perfectly happy taking the streetcar or the bus. Then the answer is buy a downtown property, even if it's a condo, or maybe you're just like, no, like the city's way too chaotic and the country that's like no man's land. Like, I'm not living there. I will still want to see civilization. And maybe the suburbs is for you. Maybe you like getting in your car and just driving down the road just to go get your mail, because you got to drive to your mailbox and you live in the suburbs. So it really comes down to whatever home ownership looks like to you, that is the right answer. There are certain properties you should stay away from, and we'll get to that in a minute. But for the most part, you're doing this for you. You're doing for what makes you happy. Because I've seen people all the time that buy based on family or friends' advice. It's like, oh my God, like everyone's buying a condo, you should buy a condo. So they go out and they buy a condo. And then 3 months they're depressed. They're like, oh my God, I can't live like this. Like, this is not me. I'm a hobbyist. I'm into cars. Like, I could barely fit my one car into the parking spot. And I was hoping to buy a muscle car. Like, so it comes down to, what's your lifestyle? What is it that you want? What do you consider home? And go for that. That's where you start. Going into what are the properties that you should stay away from? What should you buy? Location, location, location. I know it's cliched. It's said all the time on TV, social media, and conversations, but 90% of people don't even know what that means. They just think you're saying location 3 times over and just repeating it to emphasize how important it is. The reality is there's actually 3 components to location, and that's why it's said 3 times. And the first one is region. Where is it that you want to buy your first piece of real estate? Is it Toronto? Is that where you want to be? Maybe you're like, no, I want to go into the country. Maybe I'm thinking of like out in King City, right? Maybe I want to go to the outskirts of Whitby or out to Hamilton. Hey, I like wine country. I'm all about Beamsville or Niagara on the Lake. So what region, is the location in, because that needs to be factored in. Number two is the community, because you're going to live there. It's where you're going to go shopping. If you plan to have a family and you plan to have children go to school, who are they going to school with? Who are you sharing the grocery store with? Who do you walk by after you park your car, walking up to your front door? So community is very, very important. And because you can have a really nice house, live in a really nice street, but just hate driving into your neighborhood because maybe the neighbors are too nosy. Maybe there's some sketchy characters, always at the same set of lights driving into your block that always kind of puts you on edge. So community is very important, especially if you're very involved in a community or looking for community support. That's definitely something that waves in. And then the next big thing is, where's your spot on the block? Meaning, you figured out location, you figured out the community. Now, where in that community are you going to be located? And here's a simple illustration. I put the train tracks in the background. So you've narrowed it down. I'm buying my first house. I want to live downtown Toronto or downtown Hamilton. And I know that I want to be in Leslieville in Toronto. I love the neighborhood. It's got all my shops. It's got my peeps. It's, I'm just on a bus ride or a streetcar ride to work. It's where I want to be. But the house that you just bought backs onto a train track. That is something you need to consider heavily. Properties, where they're located sometimes can be bad investments. Properties that back onto train tracks, if you can't afford anything else, but you love the community and you love the region that you're in, you love the house, the only drawback, it backs onto a train track, but everything else makes you happy and the train's not going to bother you, by all means, buy it. But just understand that when it's time to sell it, you're never going to get the same amount of money as the guy directly across the street from you, because not everybody wants to back onto a busy train track, and the same thing goes to cemeteries. If the house backs onto a cemetery or power lines, things like that, just always keep that in mind. If that's the best you can afford in a community you love, I don't recommend not buying it because it's hitting all the boxes. Just understand going into it that you're buying a property that is never going to appreciate the same amount as one in the same community that just doesn't back onto the train tracks, as an example. I hope I was clear on that, because that's always a hard thing to grasp. The one type of real estate I talk people out of buying every time is anything that involves a mobile home. And right now I'm seeing a lot of those questions come up because, prices are increasing at a fast pace. People are having a hard time trying to save up to keep up with today's prices. And they're like, well, I saw this cool community and I could buy a mobile home for like $235,000 and it's got a little backyard. The trailer park looks nice. They're just bad investments. They have a tendency to not do well. The fees are usually astronomical. They're usually higher than condo fees. And most people don't realize going that in. But the biggest worrisome is that you're not buying real estate. When you're buying a mobile home, believe it or not, you're actually just getting an ownership, just much like the ownership of your car. You don't get a deed. That's what you're getting. You're getting an ownership to a vehicle that just happens to be on a piece of land that you're renting from a company. So mobile homes are probably the only piece of real estate, well, I will say absolutely under no circumstances invest your money on that. I see people all the time, even as a secondary home. It's kind of like, oh my God, I'd love to have a cottage. I can't do it. So they buy a trailer up north in Wasaga Beach. And the first 2 summers, it's great because they're up there every weekend and they love it. And then life gets busy. They're not enjoying it as much. And then they find out when they go around to sell it, the trailer they paid $53,000 for is now only worth $32,000. And the park fees that used to be $400 a month are now $600 a month. And now they're actually losing money. And I'm seeing that all the time. So I would say the biggest piece of real estate that I would venture against is anything to do with a mobile home. And just always remember, when you're out there home buying, make sure to balance your expectations versus your money. And this is crucial when you're buying your first home. HGTV has been a blessing in my industry, and it's been a curse at the same time. And what I mean by that is that these reality TV shows, so they call reality when they're the furthest thing from reality, shows that, hey, as a first time buyer, you're buying this gorgeous home and it's got granite countertops and heated flooring systems and all this stuff. Well, that's okay, but does it line up with your money? And I always say, your expectations and your money should always be in balance when you're home shopping. You know, I can find you the house of your dreams. The question is how far do you want to go? Right? Because, if you're sitting here watching this video thinking, hey, I want to buy my first house for 300,000 and I want granite countertops, I want a garage, I definitely has to be detached and it has to be in the 416. Well, your money and your expectations just didn't line up there. But if you drive far enough out of Toronto, 3, 4, 5 hours, what you're expecting to get for the prices, you're going to get it. So just always remember to keep in balance your expectations versus your money. House hunting. How do you start the process of house hunting? Once you and your agent and your mortgage broker have jumped through the first 2 hoops of the consultation, we have now secured you some good financing options. Now it's time to get house hunting. And I always say, here's some of the first things that we set up. Number one thing is share your plan with your friends and family. I can't tell you, last year it happened a handful of times to me where, I'm seeing on people's Instagram or a client of mine, it's like, hey, my cousin shared on her Instagram or on her Facebook page that her neighbor's selling their house. Mike, can you look into it? So, spread the word. If you're thinking of buying something, share it with people. Let them know what you're out to buy, because you never know. You might sometimes find a deal before it even hits on the market and just have your agent navigate you through the contracts and make sure everything is done legally and legitimately. The second thing is your agent will create a personalized portal, a personal webpage, and Eustace, you personally know what these look like. And it's basically a webpage created to you with MLS listings that is in your budget, in the areas that you're looking for, with the price points and all the features that you're looking for. And these portals is constantly screening every 12 minutes the open marketplace, and anything new that hits the market, it's grabbing it and putting it up on your webpage. And these portals, you can hit a like button, which automatically texts your agent saying, hey, there's a property that I just saw online that I really want to see. And the next step is you need to establish some type of a plan for yourselves on how to see homes quickly. And I would say in the last 8 years, the real estate market is so active. You're hearing these bidding wars happening, homes selling in 2-3 days. If you wait for the weekend sometimes to see a home, it's going to be gone. So when you're in house hunting mode, just understand that you need to have a set plan. Maybe you need to have someone on call for childcare if you have a little one that needs to be watched while you go take a look at home. Maybe you have a pet, and Rover's in your apartment when you're at work, and you're going to have to, before you get home, quickly make arrangements to go see this place before it's gone, and you may have to make arrangements. So just have some plans based on your lifestyle in place so that if the right home hits the market and you got to run and jump on it, that your life is still held in balance. As we're out there looking at houses and we finally find the perfect house and it's time to write the offer, where do we start? Well, we start with picking the right price. And that's going to depend on, the property, is it going into a bidding war, or is the seller asking this much and they've been on the market for 2 weeks and we're going to negotiate the price? And really your agent is going to be the best person to navigate you on how to pick the right price. What's currently for sale, what has actually sold in the last month or two, and compare to help pick the right price. Right now, a lot of my clients that are looking at properties, what sold 3 months ago means nothing because prices are increasing drastically because there's not much for sale. Listing inventory, meaning the number of homes on the market, is the lowest it's ever been in years. So right now, what people actually sold for is not really mattering. We got to look at what other homes are on the market for at the exact same time. How many offers are competing against us? Is it 2 offers, or like last Monday, I was in a situation where there was 37 offers on one house. that totally changes pricing strategy. So picking the price is going to be one of your more nerve-wracking things when it comes to offer time, but your agent will definitely help you navigate that. Then closing date. When do you want the keys? Because when you want the keys is also when all your money's due. So even though you may want to move into your home March 1st, your down payment may be not ready by March 1st. Maybe it needs to wait till June 1st. So you'll need to make arrangements for your closing date as well. What conditions do you need in the offer to best protect you? Conditions are things like, hey, I'll buy your house, conditional that I do a home inspection and everything is okay. That could be one of your conditions. If you're buying a rural property, a property out in the country where there's not municipal water, you're on a well. Well, one of the conditions you definitely want in there is you want a good water treatment test done. Is the water drinkable? Do I have to buy bottled water because the well water is fine for bathing, but it's not quite right for consumption? So these are conditions that you would want your agent to put into the offer to best protect you, because if these conditions come out, not favorable, you want to be in a position to cancel the deal and walk away. And then terms of the offer are things that, matter to you, but it's not going to affect the closing date or the price. So for example, some of the terms that I put in there are, hey, you as the seller, you agree that once you move out of the house, you agree to, take all your furniture with you. Don't leave your old mattress on the front lawn. We don't want to see it. Don't leave bags of garbage in the garage. Take it with you. So those are terms. Another common term that we put into offers are, hey, I know I'm getting the keys June 1st, but I want to visit the property 2 more times before the closing date because I want to come back with my mom and dad and show them the place. I'm that excited. Or I need to come back and take some measurements because I'd love to order new blinds for the house for when I move in, but they take about a month to make. So those are just common terms that we do put into offers all the time. Fulfilling your offer terms, these are things, as between the day you make the offer and it's accepted to the closing date, we're going to have to fulfill some of those terms. And I touched base on some of them. For example, getting your clean water test done, getting your home inspection fulfilled, making sure the mortgage loan is finalized. And here's what I mean by finalized. Just because you've been pre-approved doesn't necessarily mean that bank is going to give you that money for that particular address. In 90% of the cases they will, but sometimes they'll have a term as part of your pre-approval. Every pre-approval has conditions to it. Conditions like, hey, you agreed to provide photo ID. You agreed to retain the services of a lawyer, which I'll talk to you guys about in a minute. One of the big things is it's subject to an appraisal. An appraisal is the bank says, look, it's fine you bought this house. We're still willing to lend you the money, but the catch is we want our appraiser to go to the house and make sure, number one, it exists, that you're not committing fraud here and trying to walk away with $300,000 of our money. So we want the appraiser to go there to make sure it exists and to make sure that once he's in there, that the pictures that we're seeing online are the pictures of that house and that it is in that good of condition and that the price you're paying is in line with what it's worth. Okay, so that's a very common term that needs to be fulfilled by the mortgage company. And the good news is that's going to be handled between your mortgage broker and your agent. It's not something that you're really going to have to stress about, but it will be existing and happening in the background. Closing the deal. Your realtor, your mortgage broker, and your real estate lawyer are pretty much going to work together to have everything done for you on your behalf on closing. You'll have little to almost no work between that time because everything's being done on the background by your professionals. Your lawyer's job during the transaction is to ensure that the house you're buying has no liens. It's not like the sellers decided to call a contractor, put all new windows in the house, and then never paid the contractor, and then the contractor put a lien against the house. So your lawyer's going to make sure that, hey, the house you're buying, there's no liens. And if one does show up, we're going to make sure that it's discharged and paid by the seller before you actually get keys to the house. The lawyer is going to register the mortgage and title in your name. Now, I'm going to date myself here because I've been in the industry that long. Now everything is done digitally. When I started, we still had lawyers that would actually line up at City Hall with their clerks to register people's titles on their properties, believe it or not. They're going to settle all final adjustments, and adjustments is something sometimes that surprises people. When you're buying a straight freehold semi-detached house, there's not usually a lot of adjustments. Mostly the adjustments we see are used typically with condos. So for example, if you're getting keys to the condo on the 15th of June, but the maintenance fees get paid on the 1st, well, the lawyers will have to adjust the maintenance fees so that the seller doesn't overpay for that month and that you don't get away with moving in with, maintenance fees prepaid for you. Same thing goes for property taxes, especially right now, there's a lot of adjustments happening because we're in February. Most property tax bills by municipalities are due at the end of March for the first half of the year. So right now, a lot of people haven't even paid property taxes, but we're already 2 months into the year. So lawyers will do all those adjustments on your behalf. You won't even know about it half the time, but those things do get done in the background. They're going to collect funds from all parties and buy the house on your behalf. And here's what it means. So if you're buying a house with 10% down, it's like, hey, I got 5% in savings. The other 5% is coming from my Uncle Joe. And then the rest of the money is coming from my mortgage. So the lawyer is literally going to get in touch with your mortgage broker, get the mortgage money, get the money from Uncle Joe, get your money, and close all the funds on closing so that it's seamless. And they're going to establish key exchange. Traditionally, up until the pandemic started, keys were always exchanged at the lawyer's office. So on the day of closing, you would go to your lawyer's office and get the keys to your new home. Since COVID started, a lot of lawyers are not doing that anymore. Some still are. We're doing key establishments exchanges with your agent because it's like, hey, you've already been meeting with your realtor on a regular basis. They're considered part of your safe circle. So it's best that you get the keys to your new house on closing day from your realtor. Other times we're just doing a lockbox, which is this little gadget that's on the front door with a secret code. On closing day, when monies have been transferred and the title's officially in your name, your lawyer will just text you the code to that little gadget and you can just open it and the key to your new home is in there. So they'll make any key exchanges on your behalf. And now closing costs. I get this question all the time. So what's this all going to cost me? Aside from obviously your down payment. So closing costs are costs you're going to incur through the process of buying your first home. And they're all typically due on your closing date or 3 to 4 business days before the day you're supposed to get the keys is when a lot of this money is due. Your down payment, we've talked about, most of you watching have understood that your down payment you kind of need up front, but doesn't have to be in a certain account until the closing date. The rest of these fees here, I'll explain to them. These are the cost of doing business as part of buying any piece of real estate, whether it's your first home or not. Number one is the Ontario land transfer tax. And if you're in the city of Toronto, it's the only city in the 416. So if you're in the 416, it is the only city in Canada that actually also has their own land transfer tax, which means you're paying this fee twice. You're paying it to the city as well as to the province. The government obviously always wants their hand in our pockets anytime there's money. Your boss pays you, they want some money. And, same thing with real estate. You bought real estate, they want a piece of the action. Now, typically this is on a percentage basis. So on a $500,000 house, typically the land transfer tax is about $6,500. Now, the good thing is that as a first-time buyer, you have an automatic credit of $4,000, which means your actual land transfer tax fee is only $24.75, which is great. So as a first-time buyer, there is an incentive to getting this rebate. It's done instantly, so it's not something you got to mail in and wait. It's done automatically at registration. So you're saving some money there as a first-time buyer. Lawyer fees. Lawyers are nice people, but like everyone else, they don't work for free. And how it works, the industry average is about $2,000 for lawyer fees. Now, some charge 1,500, some charge 2,500. This is an industry average that I've used here. Remember those nasty CMHC fees that I told you about? They get added to your mortgage. Unfortunately, you also have to pay PST on that. So on that 19,000 that we talked about, that CMHC was going to add to your mortgage, on closing date, you have to pay PST on that money, which is approximately $1,400. Adjustments, this number will vary many times. You may have no adjustments to pay. You may have $50 to pay or $500 to pay. 500 is usually more than enough to handle any type of adjustments. And that's when I was talking about, prepaying property taxes or maintenance fees. If there was an adjustment that has to be made, that's where this money would come from. So when you take away your down payment, it's looking like closing costs on a $500,000 house is going to cost you $5,000 to $6,000. And that's a safe number to add. And as you notice, there's no fee from my realtor here on closing day. And the good news is as your realtor, realtors usually get paid by the seller's real estate agent. So when a seller puts up a house for sale, he signs a contract to hire a real estate agent to put his house on the market. And in that contract, it clearly states that, hey, when the buyer's agent shows up with the buyer, you're going to have to share your fee with him. So the good news to you guys as a first-time buyer, you get to use all of our services, all of our resources at no cost to you. It gets paid by the seller, and that's why you don't see our fee here listed anywhere.
I have a question for you, Mike.
Yep.
Going to the closing cost there. And how about the mortgage broker? How do they get paid then?
Yep, as I stated earlier, your mortgage broker gets paid by the lender. So if you decided to go with a typical mortgage broker, they shop the market, they come back and say, hey, look, Axel, we got the Teachers Credit Union and we got Meridian Financial both offering great packages for you. And you decide, hey, based on what you said to me, Mr. Mortgage Broker, I'm going to go with Meridian Financial. About a week after you get the keys to your house, Meridian Financial will send your mortgage broker a check saying, hey, thanks for bringing us another customer. We appreciate your business. That's how that works.
And on the land transfer tax, right? So that rebate is only for first-time home buyers, correct?
That is correct.
Yeah. And so what if you're buying the house? You've already told us that if you're buying a house with a partner of yours, and you're both first-time home buyers, you're allowed to each dig into your RSPs, right? Up to 35,000.
Yes.
Combine that together and have a down payment for a house, let's say. But then when it comes to land transfer tax, only will both apply, or only just one gonna apply?
You only get that one rebate. You're capped out at $4,000 and it's only a percentage, right? Here's the scary part. You're a first-time buyer, your partner isn't, you only get half the rebate.
Okay.
Right? So if your partner has already owned a condo, let's just say as an example, even if the condo was in Vancouver, right? So, but there's a trace that they've owned a condo. Well, on closing date, the government's going to say, hey, you know what? One of you's already owned property before. We can't give you the full $4,000 rebate. We're only going to give you half the rebate to the other side. But here's a cool little trick for you guys watching. You can actually instruct your lawyer where, hey, Axel is 99% owner of this property. The partner only owns 1% of this property. With an arrangement like that, you automatically get the full rebate. Okay. Just you and your partner are going to make sure you're okay with that legally being written, right? And, for most couples that are moving in as a romantic or marital relationship, that's usually not an issue. They're like, yeah, that's fine as long as it saves us money. When it's two friends or two work colleagues trying to buy a property that doesn't go very well, they'd rather pay the rebate, and I don't blame them. And this really brings me to the end. Last home ownership is yours. That's really the process in a nutshell. And if you're worried about what to do when it's time to buy your first home, it's easy. Just grab your phone, ring Mike, and I'll look after the rest for you guys. And if it happens to be in a jurisdiction that I can't service, I will still put you in touch with a professional that I know works the same way or the same style as I do. And that will hold your hand through the process the way I do with all my first-time buyers. Any questions?
Thank you very much, Mike. Thanks for sharing this with us. And as someone who's worked with you in the past, I can definitely attest to that. So I think Mike is a person that has the best interest in the offering the best service to the buyer. Actually, one other thing I wanted to add was that something that's overlooked sometimes is the property tax. Some of the big banks or some of the lenders prefer, if you're a first home buyer, that they actually charge you an amount every month, and they pay your property tax for you, which means, yes, you've done the math and you know how much you're going to pay every month for your mortgage, but you should factor in that much money added to that on a monthly basis, depending on how often you pay your mortgage. So that can add up.
Yeah, I mean, that's definitely a good point to share with people. You know, some lenders are worried that because property taxes, unfortunately, every municipality is different. Some municipalities will, like where I currently live, they can actually withdraw it monthly out of your account, no problem. And that's easy to manage from a cash flow. Other municipalities, especially in the region of Peel, you're getting 2 tax bills a year. So all of a sudden, you know, if your property tax is $4,000 a year, all of a sudden, halfway through the year, you're getting this bill in the mail for $2,000. You're just like, oh, I wasn't expecting this right now because I just fixed my car last week. And that's what the banks are worried about. And that's why some banks will say, especially first time buyers, it's like, hey, it's cool, we'll give you the money, but we're going to pay the property tax on your behalf. It just means we're going to increase your mortgage amount every month. And that's why they do that. Mm-hmm. What other questions are there? Did I go fast through this?
No, it was good timing, actually. Yeah, I have another question for you.
Sure.
So I guess probably this may resonate more with the whole community in general. For people looking to buy, let's say, 7 to 10 years from now, where would you be, looking at the trend on, where people are moving, where the houses are fairly reasonable priced for the first home buyers? Where would you say we will be looking at in 5 to 10 years from now for buying, or where would they be thinking of moving and trying to
yeah. I mean, the simple answer to that is you buy where your personal opportunity is. If you're in an industry where you're going to have a higher paying job, let's just say in Toronto or Vancouver, then unfortunately plan that even if home ownership is 10 years from now, that's where it's going to be, right? Because it'd be foolish to give up, a healthy 6-figure salary, because one city offers it, and go work for half the amount just because, home ownership is cheaper. One thing I always share with people is that just because, your work is in a certain city and you're buying your first home doesn't mean you have to live in it. And I encourage people to get started as young as possible, because we don't know how expensive things are going to be. And forcing people to think it's like, well, where am I going to move now in 5 to 7 years because things are getting so expensive? I tell them, like, rent where you love to live and where work is. Like, I've had many clients where they actually rent downtown Toronto, they work and they party downtown because that's where their life is right now. But they went out and bought their first piece of real estate in like Niagara Falls or St. Catharines because it's like, it was cheap to get in. I can afford to get into the housing market now. And it's been great. The money they're making off renting that property is helping pay down their high rent in Toronto. So financially, they're actually ahead as opposed to waiting till they can afford to buy in Toronto, right? If you are looking at outskirting communities, I always say look at the economics, I think is the big thing. And obviously proximity to Toronto has always been the big trendsetter. However, the pandemic is changing that. I mean, I think the stats were from May of 2020 to December 5th of 2020, 56,000 people left Toronto and moved somewhere else. They've never seen that kind of traffic move out of the city of Toronto, So Toronto used to have a big influence on neighboring communities of how expensive they were. Right now, what we're seeing is a trend change. The economics, the resources, especially with a lot of people being in work from home opportunities, that's starting to not matter as much. When you're looking at economics, I'll share my personal story with people. When I chose Hamilton, there was logistics to it. And when I moved to Hamilton in 2011, as you saw per the slide, like homes were dirt cheap, right? But logistically, I knew Hamilton was on the cusp of explosion, and for a number of reasons. Number one, it was the major city that divided two main highways to border towns. What I mean is, Hamilton is the central city now, either to go QEW towards Buffalo, or you're hopping on the 403 to go to London. So from a transportation industry, it's ideal. Hamilton also had the busiest port in all inland waters in the entire country. So believe it or not, Hamilton's port is the busiest port in the country, right? And I saw that happening. It's like, okay, so from a transportation, they got a lot going on. And then when I saw that Hamilton had 5 hospitals and employed, the health sciences employed more people than any other industry, like more than steel, because everyone thought Hamilton is a steel town and nothing but factories. And then when I look at the economics, I'm realizing, like, because this is starting to explode, it's just going to be a matter of time before more and more doctors and surgeons make Hamilton their home, which is going to drive property prices up. So you just want to look at economics, I don't, and when you're buying out of town from an investment, I think that's a seminar or a call we should do together at another time, because there's so much in determining it. I don't like to be in border towns. So the main 2 example would be Niagara Falls, Fort Erie, Windsor. Those towns are always fragile. And if you ever look at history patterns over the years, home prices are always doing this. And that's because border towns have very versatile, very vulnerable industries. They're just nothing but hotels and tourist spots. Those are always the first industries to get hurt whenever there's an economic shift in the economy. Border towns actually also always have the highest crime ratings because of the trafficking across borders into the US. Bordering towns, unfortunately, are always, high on drug, prostitution, human trafficking crimes, right? Like, they're always high there. So it's kind of like you want to factor that into your investment, but that doesn't mean don't invest in border towns sometimes, right? I mean, if you can come across, I remember when you can buy a house in Windsor for $150,000, but you're making $2,000 a month in rent, like, that's a no-brainer. Like, okay, yeah, your tenants are a little shady, but the government's direct depositing their ODSP checks into your bank account, so your rent's guaranteed. Okay, they're messy, they're partiers. Once in a while, the cops show up, but financially, it makes sense. But I think your highest risks are going to be those border towns. But yeah, just look at good economical layouts. Public transit is huge when picking a town, not just locally, not just because they got a bus service within them, but do they have, Metrolinx, GO stations? That's huge right now, and definitely affecting property values. Did I answer your question?
Oh, yeah, yes, for sure. It does make sense.
I don't know if this is a question for today or another time, but most of, I think from the last sessions we've had in the past, we had a lot of interest in, since some of us can't afford to buy or enter the market as a first home buyer, or it doesn't make sense because the rent is so low. What would you advise for someone or a group of people trying to get into, at least get their foot in the door in the real estate market, where you can buy as a pair or 3 friends, just so that at least you're having that gain in the market, and once you want to go solo, at least you have some capital to work with?
Absolutely, absolutely. You know, to the first part of your question, because there was a couple questions in there, renting is cheaper than buying. And absolutely in the city of Toronto, that may be the case, but it depends on for how long. Renting versus buying is only cheaper now. When you look at the big picture over 10 years, even the cost of rent is actually more expensive than buying a home. And you got to look at it this way. Every time you write a check to your landlord, it goes away. It never comes back. When you buy a property, every check you write will come back to you one day when you sell it, because you're paying it off for yourself. So that's a big difference. And sometimes where people get misled, where they're thinking for today only that rent is cheaper than buying. And again, there's nothing wrong with renting. I have several clients that own properties but actually rent, and I've done it myself too. Like when my wife and I got together, I owned a property, she owned some condos, and we actually rented because it actually made more sense for us to move into a rental together, rent out our places. What we were renting their places for totally dropped our rent, and we were living in a very, very nice neighborhood in Etobicoke with rent that was costing us like dirt cheap. So, if work is, let's say, in an expensive city and that's where you want to live and you just can't afford to buy, still buy. But now sit down with an agent. If you can find partners to partner up with you, where should we spend that money? How much real estate can we buy with our resources? So to the second part of your question, if you have 2 or 3 people that are willing to do this together, it's kind of like, okay, well, if we pool our resources, how much will the banks give us? Let's find out that question first. And depending on the answer to that question, then I can say, this is what you're going to go buy. All right. And we're seeing a lot of that. I mean, I'd say majority of the first time buyers that I'm helping right now, if they're under 32, that's what they're doing. They're still living in downtown Hamilton, Mississauga, Toronto. They're still living there. They're still renting, or they're still living with mom and dad, but they're buying properties in areas like St. Catharines, Caledonia, Brantford, these smaller cities or towns, just to get into the market. Rent them out, let it carry itself, and then guess what? In a couple of years, they're worth something. I mean, I'll share a story with you. I had a young gentleman come to me in 2015. He was 25 years old. He actually works at the Pasco in Hamilton. And, young guy, didn't have a high education, and just said to me, look, I actually have some money. I'd like to buy my first property, but I don't want to live in it. Like, I'm perfectly happy living at home with my mom and dad. Like, why would I want to move out? My mom does my laundry. She makes my breakfast. She makes my lunch. Like, I got no reason to leave, but I also know, that I should be doing something with my money. And I said, great. So I helped him buy a townhouse in 50 Point Beach back then, under 300,000. So Matt got excited and saw how that went, and we rented it out, and that went well. Well, a year into it, the property went up in value. We refinanced it. He was able to buy another one. Matt today is 31 years old. He owns 6 properties. And I share that with the group because your biggest sacrifice, your hardest hurdle, is buying your first one. And the longer you put that off, and the longer it takes you to achieve it, the longer you're postponing your wealth, and you're making dreams come true for yourself. If it means partnering up with a friend or 2 or 3 to get your feet in the door, trust me, things will quickly change down the road. Thanks to rising real estate prices and compound interest, like true wealth is on the other side of buying your first home. And that's definitely a talk we can do another day with the group. But definitely, yeah, if you got a friend or 2 that's like-minded, it's like, yeah, like I love living downtown, but we need to buy something. So let's put your 20,000 and my 20,000 together, and let's go see what we can buy out there.
Thank you very much again, Mike. We've appreciated having you today, and thanks for answering all our questions. And hopefully you let us know if one of our viewers decide to use your service.
Well, absolutely. You know what? And I want to let everybody know, it's up to Carrie and whatnot, what you guys want to do. But the slides and all the information we went through today, if anyone wants a home buying guide, like an actual PDF version with more details on what you saw today, I could definitely make that available to anyone at no cost. You know, I can have that document available to Carrie, or if people just want to send me an email, info@ringmike.com, I'd be more than happy to provide that. And as you know, use this personally, I'm not a salesperson. I don't chase you. I just give you the information, and when you're ready and able, you can reach out to me. You can ask me everything you want. I'm happy to give it for free until you're ready.
All right, thank you very much. And yeah, it looks like everyone wants part of the presentation, so I'll contact you just to get it and distribute it.
Awesome. Thank you again for trusting me, me and my services and my speech to your community. It's been a blast talking to you guys today, and I wish nothing but home ownership and true wealth to everybody on this call. I truly do.
All right, thank you very much.